In a world reeling from bailout and broken trust, Bitcoin crashed party, not with suits and ties, but with code and conviction. It wasn't minted in boardrooms or backed by governments, but carved from mathematical certainty and digital rebellion. No CEOs, no hotlines, no reversal, just pure, unstoppable peer-to-peer value transfer. Bitcoin whispered what banks feared to say. You no longer need it. It was a revolution in 21 million pieces, secured not by force, but by consensus. And beneath every block, a silent philosophy housed. Freedom is verified, not granted. Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for Sage5.tv. Going back into the ethos of Bitcoin and cryptocurrencies. Here I'm talking of the founding ethos of Bitcoin. How far are we along those lines, along those ethos? How much have we diverted? Where are things going? If you want to know more about that, please keep watching. But before we proceed with this video, guys, please note that I am not a financial advisor. I'm just some dude on the internet bringing you crypto-related content that you may not find anywhere else. We go where not many people want to go. But also, please note that this is not financial advice. This is just for entertainment as well as educational content. And if you're from the UK, this content may not be directed to you. Please do not watch any crypto-related content because the UK authorities do deem anything crypto-related to be extremely risky and they're trying to protect you. Coming back to the founding ethos of Bitcoin and cryptocurrency and Bitcoin's genesis philosophy, created in the aftermath of the 2008 financial crisis, Bitcoin was conceived by Satoshi Nakamoto as a trustless peer-to-peer digital currency. It was meant to disintermediate banks and governments, allowing individuals to transact without centralized authority. Embedded in Bitcoin's genesis block is the headline, Chancellor on brink of second bailout for banks, a symbolic rejection of state-controlled money. Some key principles for Bitcoin include decentralization, where there is no single point of control or failure, censorship resistant, where Bitcoin is unstoppable, permissionless when it comes to its transaction, immutable ledger, where it is a public record that resists tampering, and digital sovereignty, where users hold their own keys, that's their own wealth. Now, we know what's happening and we are going to try and use today's lenses when we are doing this analysis we are performing in this video. Let's start with traditional finance entering the crypto arena or the Bitcoin arena. You got the likes of BlackRock, Fidelity, and other major asset managers launching Bitcoin ETFs, banks offering custodial services and building DeFi bridges, stablecoins backed by real-world assets issued by centralized institutions. With that comes some points of tension. Let's start with control, for example. For Bitcoin and DeFi, they are distributed across nodes. That's ideal for Bitcoin and DeFi. And trade DeFi adoption trend, custody is centralized with institutions. Next, you got access. And the ideal for Bitcoin and DeFi is that of borderless and permissionless. Whereas for trade DeFi, it's KYC, anti-money laundering, and jurisdictional access. Next, you got value narrative. For Bitcoin and DeFi is digital sovereignty. For trade DeFi, it's speculative asset class or inflation hedge. Moving on to participation, for Bitcoin and DeFi, the ideal is that of open source user-run nodes. For trade DeFi, it's institutional custodians and validators. Next element is monetary integrity, which for Bitcoin and DeFi is capped supply and deflationary. For trade DeFi, it's preference for flexible monetary tools. So you can see the ideals are diverging already before we even go further. Let's look at some philosophical arguments for and against trade DeFi and its integration into the crypto space, including Bitcoin, of course. Let's start with the pros. It's legitimatizing adoption, exposure, mainstream investors. Institutions bring deep liquidity pools. Hybrid products like tokenized securities and real-world assets expand use cases when traditional finance come in. Trade DeFi's entry incentivizes robust compliance framework and security. What about the disadvantages or the cons? The first and foremost, we cannot ignore philosophical betrayal. Risks undermining Bitcoin's mission to free users from banks. The next con is censorship and surveillance, where institutions operate within regulatory frameworks, introducing KYC, AML, and blacklists. There are also custodial risks, not your keys, not your coins, which remain an eternal warning. And value framing. Bitcoin shifts from self-sovereign money to a Wall Street derivative product. I think we can start to see that now. Next, let's look at peer-to-peer and the DeFi model. This is the Bitcoin philosophy. You got sovereignty and autonomy, taking control over your own assets and your own finances. And there is innovation for open source experimentation, for example, flash loans, DAOs, and petrol. This is mostly for altcoins. Censorship resistant, which is critical for users in authoritarian regimes or collapsing economies. Are we witnessing one major economy collapsing? I bet you. And finally, on the pros for peer-to-peer and DeFi model, got global financial inclusion, where there's no need for banking infrastructure. Obviously, legacy institutions will not like that, will they? They want to retain the control by controlling your money, which if you give it to them, it's not yours. Let's go into the cons of the peer-to-peer and differ model. You got usability barriers where complex interfaces and key management remain a nightmare and inconvenient. We need proper account abstraction tools to use within DeFi and for Bitcoin as well. Scams and exploits. Trustless doesn't mean safe. Code is low, can be brutal because certain things happen and you may not be able to reverse the transaction. And lack of consumer protection. There is no recourse when DeFi protocols fail or are hacked. There are some soft rug pulls from teams as well. So is the purity of code is low really worth it? Got to ask ourselves that question. Fragmented liquidity and silo. DeFi still struggles with seamless cross-chain user experience and scalability. All that said, what might happen next? Scenario 1, institutions capture Bitcoin and or crypto. Bitcoin becomes a regulated asset class embedded in portfolios. Wall Street dominates in order books and ETFs drain BTC off-chain into custodial vaults. Majority of new users never touch chain itself, which defies the whole point of having a Bitcoin network. It's now just some commodity that is embedded within portfolios. And the consequence of all that is that Bitcoin is captured by the very actors it was designed to replace, which is an ironic ending to its ideological quest. Scenario 2, institutional Bitcoin, you're talking of ETF shares, custodial holdings, coexist with sovereign BTC held in cold wallets by cypherpunks and freedom maximalists. This is your Bitcoin maxis. This mimics the dichotomy between paper gold and physical gold. And the consequence for that is you end up with two layers of Bitcoin, one for price action and one for principle. Are we facing a fork of Bitcoin where one is going to be just for the price action, which is another derivative product, or you go with one for the principle, which is the original philosophy on which Bitcoin was founded? And scenario 3, you got the invigoration of peer-to-peer culture. In reaction to TradeDeFi co-opting crypto, new grassroots movement like Nostr, FedMint, or secular economics, for example, Bitcoin Beach, gain traction. Developers return to building tools for privacy, for example, CoinJoins, eCash, and sovereign custody. And the consequence for that is a philosophical revival that creates pressure to distinguish real crypto from institutional simulacrum will end up with a fractured crypto and Bitcoin market. Let's reflect on those three scenarios. Bitcoin is a paradox. It is an open system that invites all, even those it was designed to resist. But the integrity of its founding ideals depend not just on code, but on users' intent. If people embrace Bitcoin through Wall Street products alone, they might gain price exposure, but not the sovereignty Satoshi envisioned. Thus, the final battleground is not technological, but ethical and cultural. Will users choose convenience over control? Will developers build for decentralization or for compliance? You've got to choose. Those things are mutually exclusive, from my point of view. Either decentralization or compliance. Convenience over control. Which one are you going to choose? Compliance equals control. Decentralization equals convenience. Next, this is what I think will happen. I think Bitcoin will survive this. It will even thrive within institutional wrappers. But its philosophical victory hinges on maintaining an undercurrent of self-custody, privacy, and resistance to centralization. In short, Bitcoin is at risk of being captured not because the code changes, but because its users change. We need to think about it. The users are changing because the users that are going to Bitcoin now, they are not after decentralization or convenience. They are after compliance and control. So this is how Bitcoin is going to change. Bitcoin is at risk of being captured not because the code changes, like I said. The users are changing. So the next chapter is being written not in GitHub repos alone, but in the moral decisions of communities, the products they build, and the values they preserve. Which side are you on? Let us know in the comment section. Until the next one, guys, this is FD for SagePub.tv signing out for bye.